In this video, we are going to discuss cash value collateral loans. This is a great option to be aware of. And what we've seen, especially in the low interest rate environment we are in, is that many individuals who own whole life insurance policies or are perhaps considering whole life insurance policies, and cash value is their point of interest. They want to maximize that cash value. Often, an individual will look at the performance on the policy, then look at the loan rate on the policy. Typically, you'll see loan rates fall between 5 and 6% with most insurance carriers and say, that loan rate is too high that I'm going to pay to the insurance company. I can find a much more attractive interest rate out in the marketplace if I go to a bank or lender. Perhaps I've got a great relationship with a bank and I can actually work with them somewhat convenient. So we're going to go through the different options here, and really this is meant to provide awareness. It's not to say one option is better than the other, because people we work with use both. It's more so providing awareness. This way, when I have a policy, I can put it to use to the fullest degree possible. So with a policy loan, the number one advantage here is you have control. When you request a policy loan, typically you receive those funds in about a week, 3 to 5 business days if everything's in good order, direct deposit. It is called a loan, but we do not need to qualify for it at all. The word loan is in there really so I can receive it tax-free. Huge advantage. I'm in control when I receive it of how I pay it back. If I pay it back, if I want to pay it back systematically or just throw money at it, you have complete control. This is why people like loans from life insurance policies. Typically, you can access about 95% of whatever you have in cash value. This depends on the company and product, but that's a ballpark figure that's usually fairly accurate, give or take a couple percentage points. Can pay back at your discretion. Again, you have control of this. In retirement, many times people will take income from life insurance policies through loans and not pay them back at all. So that just really is meant to validate the flexibility you have in terms of control and paying it back if you choose to do so. Interest rates between 5 to 6%. Tax deductions. So none of this video is tax advice. We are not CPAs, just a full disclaimer there or disclosure. When you look at whole life insurance policies, loan interest per the IRS is not tax deductible. We cannot write it off. With that said, I have spoken with many CPAs over the years that feel if you are using a whole life insurance policy, taking a loan and using it for a pure business purpose or anything that ordinarily would qualify for a tax deduction, we've seen them successfully write the loan interest off. Again, the IRS views it as not tax deductible. If you have a CPA that says you can do it and they're in your back corner, it's a risk we can decide to take if we choose to do so. A CPA I really like that works with us, he's actually been on podcasts with us, Mark Welp. Not a big fan of that, just because wants to play it safe. I'm the same way in that respect, especially with the IRS. Let's progress on to cash value collateral loans. So how this works is I am taking my life insurance policy, if I have $100,000 in cash value, for example, to a bank or lender. I'm saying, Mr. Bank or bank, I've got $100,000. I'd like to assign my cash value to you as collateral in order to obtain a loan. The bank will then place what's called a collateral assignment on my policy. What this does is prevent me from going in and draining the cash value. So if I say I've got my $100,000, here you go. They place a collateral assignment on the $100,000. I receive a loan in the form of a line of credit typically, but if I want to access my money, the bank must sign off on it first. If I want to change beneficiaries, change owners, the bank receives notice and they must sign off on it first. It must be approved because there's a vested interest now that they have. Really, the reason why that collateral assignment exists is I'm saying, hey, I'd like $100,000 from you, the bank. Here's my collateral, this cash value. It prevents me from dipping into it. If I default on the loan, they can call that money or call that loan and they go into my policy, the cash value, to pay themselves back or to receive payment, I should say. So good to be aware of that. Interest rates. Right now, typically between 3 to 3.5% with most lenders we see out there. Now, underwriting, anytime I'm working with a bank, this is the question I have because it's not always fun going through an underwriting process. If I'm looking at a refinance or closing on a home, you may know that feeling. This is very simple. Typically, it's between 1 to 2 weeks. The underwriting process is very minimal. You'll see most institutions require an upfront hard credit check. They will run credit, not all of them, but some do. Some rely on the insurance company's initial underwriting, but that's about it. It's not that extensive in terms of providing income statements, tax returns, going back. They understand, I should say, banks and lenders often understand whole life insurance. It's got the guarantees, goes nowhere but up. Often banks own it. They know exactly how it works. It's a secure asset. They've stated to me, we view it as loaning against cash, very safe in that respect. So that's why the underwriting is minimal and the interest rates are very, very attractive. The term is again a line of credit. Payments, interest only. So I do give up an aspect of control where I must make interest only payments. And there is a term on that loan as well. I've seen 5 years, for example. So at the end of 5 years, they do want to re-review the loan, perhaps run another hard credit check, maybe call it, whatever it might be. But if at the end of 5 years I want out or any point in time, I need to pay it off. But while a loan is outstanding, interest payments will be due every month. Now, of course, if I want out of it, I can just borrow from the cash value and pay it off that way, and I'm back to where I would have started if I just took an initial policy loan. Tax deduction, much easier with this. If I'm using a loan for a pure business purpose, what I can do on the bank's paperwork is check off this is for business purposes. And if it normally qualifies for a tax deduction, makes life very easy because now I'm receiving a loan from a lender that would regularly qualify for a tax deduction. So now, if my policy is earning an internal rate of return, not a dividend, an IRR is very important to look at here. That's the net performance. Call it a 4%, which is very common today. If I'm borrowing at 5 to 6%, I've got a negative spread there between 1 and 2%. If I'm leveraging my policy and obtaining a loan between 3 and 3.5%, now I've got a positive spread. So it's good to look at that kind of stuff. Very valuable, especially if I'm looking at the numbers and I want it to make sense. Because remember, a cash value life insurance policy from a performance standpoint is going to kind of do what it's going to do. We always talk about that 3.5 to 5.5% net internal rate of return. That's what we can expect. Historically, it's done better, but we're in a low interest rate environment right now, and insurance companies are playing it safe. They're playing it conservative. So let's look at a quick comparison here. This was an actual case study of an older individual, late 50s, considering using a policy to purchase a large piece of real estate and what it looks like if he takes a policy loan compared to a cash value collateral loan. So here we've got a policy. He's funding it with about $2.5 million, $500,000 per year for 5 years. That's his net payment. And on the growth model, pretty straightforward. We see his break-even point highlighted in yellow between years 3 and 4. This is a maximum cash value life insurance policy. That's why we see it so cash rich right off the bat relative to traditional whole life products. Now the thing is, when you look at this actual product with this company, the dividend rate is a little under 6%. The dividend rate is a little under 6%. A dividend rate is always a gross rate, and then after the company credits their insurance expenses, mortality charges, that's going to pull that gross rate, the actual growth of my cash value down. I want to look at this. Internal rate of return. Annual, what am I earning each year if I isolate each year? And then average over the life of the policy or span of 10 or 20 years, what did it actually grow by? So what do we see here? Annually, worst part about any whole life insurance product right here. First year, negative 11, almost negative 12% hit with a traditional long-term product. Annually, here's the IRR, tops out at a little over 4.8%. Average, down here, he eventually hits north of 4.2%, but that takes some time. Now this is a safe, liquid, tax-free area to position funds, just sitting in his bank account, going to use it for real estate, but wants to park it or position it somewhere elsewhere than just pure cash. So that's where he looked at the cash value product. Now putting it into action, what's it look like if he borrows directly from his policy? So here, we see loans coming out totaling of $2 million. While he is taking those loans, he is paying interest only. So the effective loan interest rate that goes to the insurance company, 5.66%. Here's the interest rate, and then we see the interest payment. So as it comes due, he pays it. So what this means is years 2 through 5, he's paying the $500,000 plus the interest expense out of pocket. To be very clear here, then that is his plan. He's got the finances to do it. This gives him control, but his specific question was, I'm looking at the loan interest, I'm looking at the growth rate, it doesn't make sense. Everyone else I've talked to said, hey, you're just earning compound interest on everything and paying simple interest, but when I crunch the numbers, it don't make sense. Show me options. He's a numbers guy. So here we go. That's the 5.66% rate. This is a fixed rate, by the way. So no matter what happens, it's going to remain locked in. So he pays interest only and then begins to repay it right here. $500,000 per year, pays off the $2 million. On the right, let's circle this in green, net interest payments. So this is a good thing to highlight. I'm interested in this kind of stuff. What's the total out-of-pocket payments I made in interest payments, in this case to the insurance company? $452,000, almost $453,000. Cash value, growing at a nice rate, keeps on growing over time. Death benefit does as well. I get everything restored. I've continued to earn compound interest on my money as if I haven't touched it in the first place. Keeps on moving forward. But I paid $450,000 in loan interest on the $2.5 or $2 million I loaned out. It's a lot of money. Alternatively, what can he look at? Well, before we look at the alternative, right here, interest rate to the insurance company, 5.66, based on the annualized IRR, which is always going to look higher because I'm isolating the year-over-year growth. Does it ever hit 5.66%? So it's an effective cost. I have control. Yes, it is a low cost if I net it out there, but it is still a cost. Some people are not comfortable with that. This is where the collateral loan comes into play and is a beautiful option to consider in addition to a basic policy loan. So now I give up a little bit of control. I have to make interest-only payments. Depends on my comfort level. A lot of real estate investors are perfectly fine with this. But what do we notice? The growth model is going to be identical. This ain't going to change because it's the same policy. Same thing with the IRRs. Exactly the same. As we progress on, cash value collateral loan. Here we go. Instead of borrowing from the policy, he's letting his money sit and grow in cash. So these values are not going to change. There is a collateral assignment on the policy. So if we look at year 5, $2 million loan outstanding because he's borrowed $500,000 per year. Cash value, $2.6 million. If he just defaults on the loan, I'm not paying it anymore, I'm done with this thing, because that collateral assignment exists, the bank has rights to go in and say, all right, we need to recover our $2 million, which we're going to pull it from the cash value here. So he'd be left over with $620,000 in this example, if that occurred. Now, let's focus on what he wanted to look at. This individual, based off the size of this loan, he would qualify for closer to a 3% rate, no problem, with most of the banks and institutions I know out there. But with that said, we ran it a bit more conservative, 3.25. Here we go, interest rate, annual interest. In purple is his payment. So interest comes due, he pays it. Here's what I want to look at. 3.25% through year 5. Annual IRR. look at this. So it's year 5. When we look at it at just a yearly basis, if we isolate each year where he finally begins to earn more than what he's paying. But if we look at the average, 3.25, takes 9 years. And that's where we want to build awareness up front to see if it's a fit. Not to argue, hey, this doesn't make sense at all. If it doesn't make sense at all for us, it doesn't make sense at all. But we can see the numbers up front. This is where we prevent buyer's remorse or seeing something after the fact once it's too late and saying, oh man, why did I do that? Or why didn't I do this instead of the other option? If we have it up front, we can make an informed decision. So, pays back the loan over here. Loan repayment. There we go, pays it back. Cash value just keeps on cooking all the way through. And in this particular example, he was using it for real estate. So he does have that potential of a tax deduction. Great option there. So collateral loans can be very attractive, especially if we're focused very heavily on the numbers, but it is a good option to be aware of. If you have any questions or like any information on different lenders, we work with a couple of them. We don't have any financial relationships where we get kickbacks or anything like that. We just have a couple preferences that have attractive rates, but more so are very, very big on convenience and customer service. That's my most important thing. If we're working with someone, it's got to be convenient. That's really what I build relationships off of when we partner with people. But if you have questions, would like more information, reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.